Good morning and welcome to another edition of my continuing series on the international provisions of the 2017 Act. Today we're going to switch from outbound to inbound, and we're going to start by talking about the fundamentals of the Base Erosion Anti-Abuse Tax, also known as the BEAT. The Base Erosion Tax, Anti-Abuse Tax, is designed to go after payments that erode the U.S. tax base. We have this very simple example of U.S. sub having $600 million of sales and showing only $20 million of net income. That's because of this outrageously high royalty of $250 million, which we'll presume is at arm's length. So what is the BEAT? The BEAT acts as an alternative minimum tax, because on this $20 million of net income, we have corporate tax of only $4.2 million, the 21% times 20 million. So to determine the BEAT, it's 5% of modified taxable income. That's without this base erosion payment, this $250 million royalty or anything else, less the corporate tax. So our net income is really $270 without that royalty. 5% to $270 is $13.5 million, less the $4.2. The BEAT is $9.3 million. Let's talk about a few specifics. It increases to 10% in 2019 and 12.5% in 2026, only for the big companies. Those that have 3-year average gross receipts of at least $500 million, and the base erosion payments over all deductions exceeds 3%. What are base erosion payments? The classics: rent, royalties, and interest that don't incur withholding at the statutory code rate of 30%. It also includes purchases of depreciable property from the foreign parent, but it excludes inventory, so that cost of goods sold isn't a base erosion payment. There's going to be a $25,000 penalty for failure to properly report. How the IRS is going to require you to report it, I don't know. My guess is it may be an enhanced Form 5472. Well, thank you very much for joining me today. Next time we'll dive into a little more specifics with respect to Base Erosion Anti-Abuse Tax.